When real estate investing is done correctly, it can lead to generational wealth and massive tax breaks. It's happening currently right now for many of my clients, and it's happening for me and my family. Today, I'm going to show you exactly how to find the right real estate deals so that you can benefit tremendously from the investing strategy as opposed to being harmed by it. Without further ado, let's dive in. All right, guys, here's a step-by-step guide to finding good real estate deals. And I want to make sure that you know that this guide is really meant to help you if you're a new real estate investor. We're going to jump right in. Step number one is knowing what kind of real estate investor you're going to be. The deals that are ideal for one type of real estate investor are going to be different from the deals that are right for another type of investor. So right off the bat, you need to figure out what type of real estate investor you're going to be. That is the only way that you will be able to figure out which properties to look for and if they're the right type of deal for you to invest in. Karlton, what type of real estate investors are there? There are many different types of real estate investors. For example, there are long-term real estate investors, short-term real estate investors. There's people who prefer to flip real estate, people who prefer to wholesale real estate, people who are only in the commercial space as commercial investors, and there's much more. Flippers are investors who buy properties that are typically distressed, and they fix them up and they sell them at a profit. Wholesalers are real estate investors who try to buy and sell properties on very short timelines without actually having to put up a whole lot of capital. They actually secure properties under a contract, and then they sell the contract to another real estate investor within 30 days so they don't have to put up any money themselves. If you're someone who doesn't want to hold on to properties for a long time, then being either a flipper or a wholesaler could be a good option for you. Plus, you might be looking for more upfront cash, which is why people start off with flipping or wholesaling versus investing into real estate where they're looking for long-term appreciation. If you're someone who wants to hold on to the property for a long period of time, then being a long-term investor or even having a short-term rental or commercial investment property would be more preferable and better for you. For the rest of this video, I'm going to focus on long-term rentals and short-term rental investors because these are the kinds of investors I work with the most at my firm. Let's move on. Step number two, now that we understand what type of investor we are, we need to look for markets with rising or at least stable demand. As a real estate investor, we want to own properties in places where we know that there will be plenty of demand. Some real estate investors make the mistake of buying real estate in an old town or a city without doing any research to try to figure out what the rental demand will be like in the future. This is a very big mistake. We want to do the complete opposite of this. We can already have some idea of what the rental demand is likely going to be in the coming years by looking at statistics such as population growth, job growth, and infrastructure development. Looking at information like this can actually be extremely beneficial for identifying good markets, and at the very least, you want to make sure that the population is staying stable and not declining. Ideally, though, you need to find a market where population is growing steadily. This can help to increase rent prices and price appreciation for the property that you end up buying in this market. Once you identify some good markets, then and only then can you start looking for properties on websites like Zillow, Redfin, Realtor.com, and Trulia. If you get excited and you go to these websites first, you won't have a plan in place. You're just shopping like you showed up to a mall. This is not how wealth is built. We don't show up to a mall and just buy liabilities. We buy true assets. Here's step number three. Step number three is looking for cash flow positive properties, not cash flow neutral. A cash flow positive property is a property that generates more rental income than the total expenses for the property every single month. For example, if your total expenses for the property per month are $2,500, the property would be cash flow positive if the property is bringing in more than $2,500 per month in revenue. A lot of real estate investors don't even do any calculations before buying a property to figure out if it's cash flow positive from day one. This is a mistake. It is much easier to succeed in real estate if your properties are cash flow positive right from the get-go. That way you can be profitable from the onset instead of trying to chase profitability over time. Now, to calculate whether a property is cash flow positive or not, you need to estimate both the rental income and the expenses, including taxes and insurance. Then and only then, you subtract the expenses from the rental income. Karlton, am I doing math with you right now? Yes, you are. If the number is positive, the property will be cash flow positive if your estimates are accurate enough. You can use rent projections from tons of real estate companies online. Even sites like Zillow or Rentometer will give you an estimate of the rent. Now, step number four is a very crucial part. Looking for properties with good building to land ratio. This is one factor that is an expert level factor that most real estate investors will never tell you about because they don't tell you about this until they've owned multiple properties and they've felt the ramifications of big tax savings. This one factor for identifying good rental properties can make or break a deal for you. When I say a good good building to land ratio, what I mean is that at least 80% of the total property value is comprised of the building structure and 20% or less is comprised of land. The reason why this is so important is because as an investor, you're not allowed to claim depreciation for the land. That portion of the property is not a write-off. You can only claim it for the building structure and improvements. This is because land doesn't break down over time. Land just kind of stays exactly the same for thousands of years. Yes, maybe some grass will grow on it or some trees, but the land itself doesn't break down. So if you invest in a property with a high building to land ratio, then you can potentially get a larger depreciation deduction for your investment. This can help you to save a substantial amount of money on taxes and make your investment more profitable. Step number 5. Look for properties in states that allow accelerated depreciation. I cannot stress this enough. I learned the hard way. I bought my first property in California, and when I went to do a cost segregation study on it, I found out the hard way that California does not conform to depreciation acceleration. I had to add all the depreciation that I accelerated back onto my tax returns on the state side, and then I pay taxes. That sucked because I love not paying taxes and then going on the internet and bragging about the fact that I don't pay any taxes. So I want you to listen up here. Under standard depreciation, the IRS uses the modified accelerated cost recovery system. You don't have to memorize that, but it's just a system to spread the cost of a residential rental property, excluding land value, over the course of 27.5 years using straight line. Now, for commercial property, it's 39 years. However, you can accelerate this timeline by performing a cost segregation study. I talk about it all the time on this channel. If you want a whole lesson on what a cost seg is, watch this video right here. But a cost segregation study allows you to segregate the cost of the building into 2 categories, structural and non-structural. Non-structural components of a building, such as light fixtures, flooring, appliances, can be depreciated faster, allowing for substantially larger depreciation deductions in the first few years of ownership. But although accelerating depreciation is highly advantageous for real estate investors, some states restrict your ability to accelerate depreciation. For example, California, New York, Connecticut, and many other states restrict it. This sucks. So if you own real estate in any of these states, you can't take accelerated depreciation on the state side. You can only maximize on the federal side. You may want to consider only investing in states with friendly rules for accelerating depreciation, not to say that that should discourage you from investing. Step number 6 is networking with local real estate professionals to find off-market deals. This is where you have to slow down if you really want to build wealth quickly. Most people are just going to go to Redfin, Zillow and think that all the best deals are there. But one of the best ways to find great real estate deals is to tap into off-market opportunities, properties that are not listed on the MLS or public platforms like Zillow, Redfin, and Trulia, where everyone else has access to them. These deals come with less competition. They come with better pricing, which can boost your cash flow and profitability. To find off-market deals, you have to build relationships with local real estate professionals like real estate agents, local wholesalers, property managers, and even contractors. You might have to attend local real estate investing meetups, join an investing club, join online forums, or just reach out directly to professionals in your target market. Let them know you're a serious long-term or short-term real estate investor and that you're in the market for cash flow positive properties that are off market, and see if they will be willing to send over some deals to you or at least create a deal network. Over time, leveraging these relationships will pay off for you. It's definitely paid off for a lot of my clients, and these connections can tip you off to off-market listings or motivate sellers before they actually are planning on selling. Because if you know somebody that is a great wholesaler, for example, they might offer you a property at a discount because they know you're a reliable buyer. Our property manager might know of a landlord looking to sell quickly. So by networking proactively, you'll get access to deals that other investors will never get. Plus, you have a competitive edge. Now, step number 7 is taking the property's inspection seriously to avoid properties needing major repairs. When evaluating potential real estate deals, you have to take the property inspection super serious. For long-term and short-term real estate investors, this is critical. The condition of your property directly impacts your cash flow and profitability, not today, not tomorrow, and 5 years from now, and 10 years from now as well. So a thorough inspection by a qualified inspection person can uncover issues that might not be visible during a casual walkthrough. A proper inspection can help you avoid costly surprises that could derail your investment goals. Skipping or rushing this step is a common mistake that can lead to financial headache down the road. I have seen seen it happen so many times. The last thing that you want is to buy a rental property only to discover that it needs a $30,000 roof replacement 3 months after owning it, right? So focus on identifying properties in solid conditions, steer clear of those that require massive repairs, such as foundation issues, extensive roof damage, outdated electrical and plumbing systems. Minor repairs are okay, but major repairs can quickly eat into your budget, delay your ability to generate rental income, and turn a seemingly good deal into a money pit. For example, a property with a crumbling foundation could cost tens of thousands of dollars to fix, just so you know, wiping out your cash flow for like 2 to 3 years. Instead, why not look for properties with minor cosmetic issues like outdated paint, worn out carpets that can be fixed affordably to boost value without breaking the bank. Now, to ensure you have a sound investment, hire a reputable inspector and review their reports carefully. If the inspection reveals significant structural or system-related problems, be prepared to walk away from the deal. No matter how attractive the price seems, always be prepared to walk away from the deal. You can also negotiate with the seller to cover repair costs. That was something my wife and I did on our first property, and it lowers the price if you need to. Also, you can lower the price if minor fixes are needed, but always prioritize properties that are move-in ready, that require minimal work. This is how you can build wealth fast, by eliminating unforeseen expenses. By being diligent during the inspection phase, you will protect your investment and set yourself up for a consistent real income and long-term success. Last but not least, work with Tax Alchemy. If you're new to real estate investing and if you want additional help finding incredible real estate deals, then click on the link in the description below this video to book a call with my company. We work with a powerful network of real estate partners who are experts in finding the best possible real estate deals, including many that are just completely off market. These deals help our clients to take advantage of the cost segregation study, maximize the short-term rental strategy, even leverage the self-rental strategy, and all 100% optimized for tax benefits for you. In addition to cash flow and price appreciation, you're getting those tax benefits, and I love that. Working with the right company can be a massive game changer when it comes to finding great deals, and it can also save you a lot of time, stress, and hassle to simplify something that should be simplified. If you are here right now and you're like, I don't know if I have the budget based off of my specific goals, book a call with our team. It is totally fine to allow for our team to determine that for you. If you're interested in working with us, allow for us to determine if it makes sense. Also, watch this video right here if you want to learn more about tax strategy and how it can benefit you if you were to go into real estate investing. That's all I got for today's video. I love talking real estate. I love being able to help new real estate investors find that right property, accelerate depreciation, offset W-2, 1099 income so they can reinvest into that second property. And we can just keep doing this every single year. My vision has been for a lot of my clients to just acquire one property a year, one property that can offset your tax bill, and we park money and we save money in that asset. And we just continue to build our wealth like this. If you like this and you want to work with somebody that is passionate about helping you build wealth, look no further than Tax Alchemy. Look no further than this channel. Thank you so much for watching this video. If nothing else, like, comment, subscribe. I'll see you on the next one. Cheers.